Okay, so I suggest we start, and I wish to welcome you to this fifth RISIS Research Seminar. So we have established this series around the RISIS Research Infrastructure project in order to foster exchange on novel research based on RISIS. RISIS is a large European infrastructure project which provides different type of data sets and infrastructure to researchers in research policy, innovation studies, higher education studies. Among them, there is an important presence of data sets about firms and innovative firms, which is closely related to the topic of the present seminar. So I would like to welcome Benedetta Montanaro, who is PhD students in management engineering at the Politecnico of Milano, who will present a paper on venture capital, initial public offerings, and valuation of entrepreneurial ventures acquisitions. I wish also to welcome Tom Vanacker, Professor of Finance at University of Ghent, who kindly accepted to be discussant of the seminar. And the program is Benedetta will first present. It would be wise you stay within, say, 40 minutes. Then I will give the word to Tom for discussing, and then we will have an open discussion. So thank you, and Benedetta, it's yours, the floor.
Okay, thank you very much. Thank you very much for inviting me. I will now try to share my screen. Just 1 second.
Okay.
Okay. Let me know if you can see it properly.
Yes, it's fine.
Okay, so thank you very much again for inviting me and giving me the chance to present my paper today. My name is Benedetta Montanaro. I am a third-year PhD student in Politecnico di Milano, and I co-authored this paper with my supervisor, Professor Massimo Colombo. And as you can see from the slide, the title of this paper is Signal Sequences, Venture Capital, IPO, and Evaluation of Entrepreneurial Venture at Acquisition. So as you can see from the title, this paper focuses on the valuation that entrepreneurial venture get when they are acquired. Why are we interested especially in acquisition? First of all, because acquisition is popular. Acquisition have recently become more and more appealing for young companies and venture capitalists willing to exit their companies, either to satisfy their liquidity needs or because they want to reinvest the proceeds that they get at exit into new activities to finance new businesses and contribute to the development of the entrepreneurial ecosystem. However, at the same time, acquirers find it extremely difficult to decide how much to offer for the target company shares. This is valid in general. It is even more true if we are talking about entrepreneurial venture, as in this case. Indeed, entrepreneurial venture are characterized by high uncertainty, untested resources, intangible assets, no track record, and in many cases, they are reluctant to divulge information due to the high risk of knowledge misappropriation. In other words, entrepreneurial venture are characterized by high information asymmetry that prevent outsiders to distinguish good from bad companies. From a theoretical point of view, the theoretical lens that has been used in literature to tackle information asymmetry, the main theoretical lens, is signaling theory. Indeed, to overcome information asymmetries when information disclosure is not possible, prospective investors rely on signals. And signals occur in the form of observable and costly decisions taken by high-quality firms that distinguish them from low-quality companies for which bearing signaling cost is unprofitable. Few studies applied signaling theories in M&As, and these studies show that affiliation with reputable venture capitalists and with high-quality alliance partner work effectively as signals. However, despite the achievement of this literature, important issues have not been discussed yet. So the first gap that we would like to tackle with this paper is that the works that I was mentioning before, so the works that applied signaling theories on M&As, have been performed on samples containing only public companies. However, there is evidence in previous literature that going through an IPO can be used by companies to increase the likelihood to become target of an acquisition. Indeed, there is an increasing number of companies that decide to go for a non-linear financial path, so to go for the IPO as a step to conquer a subsequent acquisition, following the so-called dual tracking strategy. Indeed, going through an IPO reduces drastically the information asymmetry surrounding a certain company. And also, being the listing process highly costly, going through an IPO can also be considered a quality signal because it helps outsiders to distinguish high-quality companies that can bear the listing cost from low-quality company for which it is not profitable to go through the process. The second gap that we would like to address is the fact that in signaling theory, the effect on firms' valuation of the temporal sequence of signals characterized by different strength is understudied. Indeed, in dealing with multiple signals, extant research has mainly focused on signal bundling, defined as the simultaneous occurrence of multiple signals. However, signal sequences have some peculiarity that should not be overlooked. So, in order to tackle both the gaps highlighted before, the overarching research question of this paper is: how does going through an IPO before being acquired interact with another well-studied signal in literature, that is BMVC-Beckett, in determining the valuation that entrepreneurial ventures get when they are acquired? First of all, we focus on the first gap of this paper, so the effect of previous IPO. In particular, we are interested in understanding if the signal effect attached to going through an IPO before the acquisition is similar to the effect of BMVC-Beckett. Indeed, we know, as you can see from this table, that BMVC-Beckett has a general positive effect on the valuation that entrepreneurial venture get when they are acquired. Moreover, if we introduce the concept of signal strength, there is evidence in literature that being backed by a high-quality venture capitalist brings a higher effect than being backed by a low-quality venture capitalist. With our hypothesis number one, we would like to see if a similar effect happens also for the IPO-related signal. Therefore, we would like to test whether going through an IPO in a high-quality stock exchange brings a higher effect than going through an IPO in a low-quality stock exchange. This is summarized by our hypothesis number one that says that doing an IPO before being acquired is expected to be positively related to the valuation obtained by entrepreneurial venture at acquisition. And in particular, we would like to test whether companies that go public in a high-quality market obtain higher valuation at acquisition than companies that go public in a low-quality market. At this point of the paper, with our hypothesis number two, we would like to tackle the issue of signal sequences. Indeed, we choose two signals, BMVC-Beckett and going through an IPO, that usually happens in sequence, with the VC-related signal happening before the IPO-related one, usually. In this paper, we would like to understand how receivers interpret signal sequences in the acquisition context. And in particular, we would like to compare the valuation obtained at acquisition by private and non-VC-backed companies with the one of companies VC-backed and or that went through an IPO before the acquisition. Moreover, we would like to introduce the concept of the signal strength, even if hypothesis number two. So we would like to disentangle companies that were backed by a high-quality VC from company backed by low-quality VC. And the same we would like to do for the IPO. So we disentangle companies that go public in a high-quality stock exchange from companies that go public in a low-quality stock exchange. And we compare these different financing paths. So as I said before, in this paper, we are focused on the interpretation of signals by outsiders, by potential acquirers, by investors. Indeed, although the origins of signaling theory lie in economics, management scholars have already adopted a broader set of theoretical assumptions that concern the way in which signal receivers process information coming from the signal. There is evidence in literature that signal receivers do not perceive all signals in the same way due to the fact that they are bounded rational. And indeed, there are aspects of the signaling environment that may make signals more or less observable. With this paper, we would like to challenge the mechanistic understanding of signalings and try to investigate how signal receivers perceive and interpret signals characterized by different strengths coming in sequence. So we consider the fact that the receivers of the signals, so the potential investors, is characterized by bounded rationality, saying that when the first signal is received, the receiver sets an estimated valuation for the company's end index signal on the basis of the strength of the signal itself. This estimation will become a reference point called aspiration level that will be used when a subsequent signal will be received. Indeed, when the second signal is received, the receiver will adjust the estimated valuation for the company's end index signal, not just looking at the second signal as is, standalone, but comparing the effect of the second signal with the reference level set previously. This echoes some works on probabilistic search theory, according to which decision makers in general have certain aspirations that define an acceptable level of performance. And whenever they receive new updated information that reveals performance shortfall compared to the acceptable level of performance that they have in mind, they implement a probabilistic search that brings them to adjust the decision-making process by identifying local solutions that could restore performance to the aspired level. Indeed, processing information is costly, and we start from the assumption that the receiver of the signal will update the valuation of the company, so will process the information coming from the new signals, only if the second signal is far, especially below, from the reference point set after the reception of the first signal. Let's see the interaction effect, and let's focus for a moment on what happens when a company goes through an IPO in a high quality market. As we said before, going through an IPO in a high quality market is expected to bring a higher effect than going through an IPO in a low quality market. What happens if the company was VC backed by a low quality venture capitalist? In this case, going through an IPO in a high quality market goes beyond the expectation of the investors, the expectations, the aspiration level set by the investors when the first signal was received. Indeed, we expect that the effect of going through an IPO in a high quality market for companies backed by low quality venture capitalists is even higher compared to the case in which the company was non-VC backed. What happened instead to companies VC backed by a high quality VC that goes through the IPO in a high quality market? Well, in this case, the second signal, so going through an IPO in a high quality market, is aligned with the aspiration level set when the first signal was received. They are both signals characterized by high strength. In this case, since processing information is costly, we expect that the investors, so the potential acquirers, do not update the value of the company. So we expect a delta equal to 0. What happens instead when the companies go through an IPO in a low quality stock exchange? Well, in this case, if the company was previously backed by a low quality venture capitalist, we do not expect to see any effect on the valuation for the same reasons as before, so the two signals are aligned. While if the company was backed by a high quality venture capitalist, in this case, we can even expect a negative effect of going through an IPO in a low quality market. Indeed, the second signal is below the aspiration level set previously by the investors. So investors will update the valuation of their companies and will turn towards other companies in which they are willing to invest with negative consequences on the valuation. So in case the company was backed by a high quality VC, we expect a negative marginal effect of the IPO in a low-quality stock exchange. All of this is summarized in hypothesis number 2 that I'm not going to read because it is the same that I just explained you with the table before. So let's talk about the data of our paper. Our unit of analysis is the evaluation of acquisition that entrepreneurial venture got. So in order to obtain our final sample, we started from RISIS VICO 4.0 database. This database contains information on European plus Israeli entrepreneurial ventures founded after 1988 and that received at least one venture capital round within 10 years since their foundation, and in particular in the period between 1998 and 2014. So we have the population of more than 24,000 VC-backed companies in Europe plus Israel. As a second step, we downloaded from Orbis a random sample of more than 225,000 companies, non-VC-backed companies, that we matched with the VC-backed companies of VICO 4.0 through the coarse-net exact matching algorithm, using as predetermined variables, variables related to the geographical location of the company, related to the industry of belonging, and related to the company age. And for VC-backed, we consider the age of the company in the moment in which the first round of investment came. After the matching, so through the coarse-net exact matching algorithm, we managed to match more than 16,000 VC-backed with more than 222,000 non-VC-backed companies. As a third step, we relied on Zephyr database to download information on the acquisition deals of European companies, where European companies were target of acquisitions, happened between 1997 and 2017. Of course, we considered as acquisition only the deals where a majority stake was acquired. After including information on acquisition, we derived a subsample of more than 7,000 companies divided into 1,888 VC-backed and 5,128 non-VC-backed companies. As a last step, we discarded observation with missing values on the acquisition valuation or on the total asset in the year before the acquisition, and we obtained a final sample of 280 companies, 722 VC-backed and 1,358 non-VC-backed. And of these more than 2,000 companies, more than 300 did an IPO before the acquisition. As far as the model is concerned, we applied the 2 OLS regressions. So first of all, we are interested in capturing the presence of a venture capitalist, high or low quality, and of a previous IPO, high and low quality. And then we included also the interaction between these variables. As far as the variables are concerned, our dependent variable is the logarithm of the Tobin Q of the companies, so of the entrepreneurial ventures at the moment of the acquisition. Among independent variables, we have a dummy that measures whether the company went through an IPO or not before the acquisition. That was split into IPO US and IPO else, and a second dummy measuring whether the company was VC-backed, again split in venture capital US and venture capital else. Indeed, we use alternative measures actually to try to give a proxy of the strength of the 2 signals. In this case, I'm going to present you one of these alternative measures, that is the location in which either the IPO or the venture capitalists were based. Indeed, in particular, we consider that being backed by a venture capitalist from the United States is more difficult, is more challenging, is more costly for European-based company, and the same goes for going through an IPO in the US. Therefore, with this measure of strength, we have that IPO US and VC US measures corresponds to the strong signal, while IPO else and VCS corresponds to the weaker signals. We included also the interactions between these 4 dummies, and we included also different control variables related to the size of the company, the age of the company and the moment of the acquisition, the industry in which the company is operating, the market sentiment, the performance on the stock exchange, of course for public companies, and also the inverse mean ratio that took into account the probability of becoming target of an acquisition, computed through an Ekman model. So let's look first at the model with without the measure of the strength of the signal. So we just included IPO dummy, VC backed dummy, and the interaction between the two. As you can see, we can see immediately a high positive and significant effect for the VC backed dummy, but nothing can be actually concluded regarding the IPO dummy because we lack significance. Let's see what happens when we split the signal into high quality and low quality, or into strong and weak. So as you can see from this table, in which we first focus on the VC, so VC US versus VC else, we can see that the effect of being backed by a US venture capitalist is higher in terms of size, but however, both the effects are positive and significant. So this is in line with what we expected starting from the theory, the literature. If we look at the effect of doing an IPO, so IPO US versus IPO elsewhere, the coefficient of IPO US is positive and significant, while the same cannot be said for the coefficient of IPO else. So it seems like that going through an IPO in a market which is not in the US do not bring any effect on the valuation of companies at acquisition. Okay, so if we look at the interaction effect, and if we look in particular in the effect of going through an IPO in the US, we see, if we combine the two coefficients, that overall, going through an IPO in the US for a company that was backed by a US venture capitalist slightly decreased the benefit that going through an IPO in the US as is brings. However, we lack significance, so the coefficients are not significant, so we cannot actually conclude anything. If we look at the effect of going through an IPO in the US for a company backed by a low quality VC, actually the same, it is the same as before, so we cannot actually conclude anything because we lack significance in the coefficients. So we see a slightly negative effect of the interaction, but we lack significance, so we cannot conclude anything. Let's look at what happened if we consider the effect of going through an IPO elsewhere, so not in the US. Actually, if the company is backed by a high quality VC, a VC from the US, we see a negative and significant coefficient of the interaction variable. So it looks like our hypothesis number 2 is confirmed. So going through an IPO in a low quality market, if you are backed by a high quality VC, brings negative effect on the valuation of the companies at acquisition. If we look at the interaction of IPOs and VCs, nothing can actually be concluded because, again, we lack significance in the coefficient. In order to see if our hypothesis number 2 is confirmed, or at least is partially confirmed, we perform the pairwise comparison of the average marginal effect. So, and again, if we look at this table, we see that the effect of going through an IPO elsewhere, if you are backed by a US venture capitalist, is overall negative and significant, so significantly different from the effect of going through an IPO elsewhere in case you were not VC backed at all. So our hypothesis number 2 seems to be partially confirmed. So we can say that going through an IPO in a low quality market, in case you were backed by a high quality company, brings a negative marginal effect. We computed different robustness checks. So first of all, we computed the strength of the signals of the IPO and the VC backed signal with alternative measures, as you can see from this big table. So actually for the IPO, we disentangled company that were reputed by high quality underwriter from company that were characterized by low quality underwriter, and we also include, so as a first alternative measure, and as a second alternative measure, we distinguished company that went public in a stock exchange characterized by high market cap from companies that went public in a stock exchange characterized by low market cap. As an alternative measure to to distinguish VC high quality from VC low quality, we use the reputation of the VC. So we distinguish companies backed by highly reputable VC from companies backed by lowly reputable VC, where the reputation of the VC is measured as the total number of successful exits that the venture capital had in the 5 years before investing into our company. As a robustness check, we also implemented the instrumental variable approach on the model with no strength, involved. So where we have only IPO dummy and VC-backed dummy, indeed we know that both the variables are endogenous. And so we used two instruments. Actually, we instrumented these two variables with the logarithm of the IPO market sentiment at the year in which the company was founded, and the logarithm of the minimum distance between the company and the closest venture capital hub in Europe. We did the estimations with the IV regress approach, and so as far as the model with no strength is concerned, and we see that the effect in terms of size of the coefficients at significance are more or less the same. As a second robustness check, we computed the average marginal effect on the firm age to see whether the effect of signals, both IPO-related and VC-related signals, were greater for younger companies compared to older companies. So if we have actually a signaling effect related to going through an IPO before the acquisition and being VC-backed, and not just a substantive benefit effect. And also in this case, it seems like we have a signaling effect because the effect of going through an IPO and being VC-backed is higher for younger companies. We also considered a model in which we included the time elapsed between the two different signals. And again, we do not seem to have significance when we put into the model the timing between these two different signals. So it seems like we don't have an effect that depends on the timing between the signals. And as last robustness checks, we considered the investment base at the exit. So we didn't consider all the venture capitalists that invested in the company along the whole life cycle, but only the venture capitalists that were present in the moment in which the company exited. So for the companies that just went through the acquisition, we considered the investment base at the moment of the acquisition, while for the company that also went through the IPO, we considered the investors present at the moment of the IPO. And again, the results that we got recomputing the variable of the VC-related signals with this new investment base are similar to the results that we obtained in previous models. So to conclude, with this paper, we saw that going through an IPO before the acquisition does not necessarily bring benefit. Indeed, it brings benefit if the IPO is done on a high-performing stock exchange, while if the IPO is performed on a low-performing stock exchange, on a low-quality stock exchange, it doesn't bring any effect unless the company is VC-backed by a high-quality venture capitalist. Indeed, in this case, going through the IPO in a low-performing stock exchange set aside the positive effect of the VC affiliation. Speaking about the limitation and the contribution of our paper, we have some main limitation, mainly deriving by the lack of generalizability of our results. Indeed, we only speak about the European market, which is, for example, different from the US market. And we have some control which are still missing. For example, we are thinking about including in the model controls for the level of the competition during the acquisition, so the numbers of potential acquirers interested in buying the company. Speaking about the contribution, from a practical side, we provided practitioner interest in the dual tracking phenomenon with valuable insights. In particular, we saw that going through an IPO before being acquired can become a double-edged sword. While from a theoretical point of view, we integrated signaling theory with the probabilistic search theory, and we provided insight into signal sequences under vendor rationality assumption. And this is all from my side. Thank you very much for your attention, and I'm happy to see your questions.
Thank you very much. Could you just stop sharing the screen so that we can see the audience? Okay, so thank you. I would like to give the word to Tom for his comments.
Thank you. This is the first time that I'm working with, so I'm going to try to, share. Okay, that seems to work, right?
Yes, I can see it.
Yes, it works.
Okay, great, thank you. So thanks for the opportunity to discuss this paper, which I enjoyed reading. How I'm going to structure my discussion is I'm going to very briefly recap. I think the presentation was very clear by itself, so there's no need to do a big summary again. I'll get to the strengths, and then obviously probably my main goal today is to provide some feedback which might help you to further develop the paper. So in terms of overview, I think the research question is, well, what happens in terms of signal interpretation when you have multiple signals which are communicated at different points in time, and if there has been an early signal that might give expectations or set aspirations which influence the subsequent signal in terms of how it affects, in your case, acquisition valuation, but it can be outcomes more generally. So research question: how does a prior signal influence the effectiveness of a latter signal? In terms of data, more than 2,000 European and Israeli entrepreneurial ventures that have been involved in an acquisition, and the key finding is probably that if you start with a specific signal which is strong, high reputation VC, attracting high reputation VC, and later on you communicate a signal which is weaker, which means going to a less prominent IPO market. I've noticed you talked about low quality IPO market. I would not necessarily call it low quality, but it's probably a bit less prominent. So those less prominent IPO markets. So if you combine those conflicting types of signals, that it might eventually negatively influence the valuation of acquisition targets. In terms of strength, very interesting topic. I think from reading the paper, you also have a good idea of your audience. There's a few people who have worked on signaling and acquisitions, but not that many. And I've noticed that you covered them well in your paper. Also the entrepreneurial finance literature, but that's no surprise, I would say. I think it's an interesting question. So great question with very good potential. Impressive data sets, interesting results, which were presented also with taking care of or at least acknowledging robustness and doing multiple robustness checks. So I think all of these things will be very much appreciated by your readers. So that brings me to probably the main point, that is some specific sets of feedback that I could share. What you see is that I might have borrowed from your presentation in the sense that I've used your summarizing graph here to get to a couple of questions that I had while reading the work. The first question that I have, and that I think you need to be a little bit more explicit about in the paper, and that's probably by adding a paragraph on a strategic place somewhere within the paper, is, well, why would these old signals matter? And I know that you take into account the timing of the signals in a robustness check, but when you're talking about informational asymmetry in the context of acquisitions, I would agree, but we also know that potential buyers spend a lot of time at doing a very detailed due diligence of the targets. And so if you have that detailed due diligence where experts help you in terms of valuing the company, why would those older signals, which reflect things from the past, why would that still be impactful for a valuation which in theory should be more future oriented? So I'm not saying that it is not important, those signals, but I would need a little bit more of clarification given the process of acquisitions and the due diligence which takes place. Why would the signals still matter in that context? The reason why I asked that question is because I've worked on a couple of papers on signaling myself, and this is actually a question which I got from reviewers at different occasions, and so I'm now transferring it to you as well. That is, well, you know, given that environment and the context in which you're looking, why would those signals still matter? Yeah. Second thing is, related to that is the IPO signal and the venture capital signal. They can be further away in time. There's probably more recent signals around the time of the acquisition, and I'm wondering what could those be, and would there be a possibility to include them and potentially as controls, or so what about the more recent signaling environment? Because what we know is that firms will convey many signals over time. And so the question is, why exactly those two, which are here? From an entrepreneurial finance perspective, I can understand that we typically, if companies get to VC, then the next stage is hopefully to get to the IPO. So I can get that from an entrepreneurial finance point of view, but for a more general audience, why those that are further away in the past and not taking into account some of the more recent ones? And for example, in your introduction, you were talking about the difficulty, for example, to rely on other types of signals because some of those companies are very young. And in a sense, that's true, but in a sense, that's also not entirely true because some of them have been going through venture capital funding at several rounds, have done an IPO, and some of the signals which you highlight in your introduction that are not available, such as analyst coverage, media attention, might actually become available at specific points in time for specific subsets, at least, of the companies that you're looking at. And so that is just, I think that's something that you need to build in your introduction and your theorizing. What about the due diligence? What about other signals that might be there? Why focus on the signals that you are currently focusing on? So that's one specific recommendation. Another point that I have is relates to the probabilistic search. I like the idea in that you combine what I would call a more behavioral perspective in the signaling literature, because much of the origins of signaling and signaling theory have been inspired by a rational point of view of participants or receivers. So the fact that here you take this more behavioral perspective is something that I like, but I would need a little bit more clarification. And let me clarify what I mean, or some of the points of attention that I have in mind. First one relates to this process, and that is that in writing the paper and also in the presentation, you start with the VC signal, yeah, and then there's the IPO signal. And I know that these things, there is generally first the VC signal and then the IPO signal. However, for a potential buyer, when they look at the company, those two signals appear at the same point in time. The buyer looks at the signal at a point T. The signals have happened at different points in time, but the buyer can see sees the two signals potentially together. Yeah? And so my question is, why, as a potential buyer, would you start with the VC signal and then go to the IPO signal? I think it's also likely that if you're a buyer of a company, the first thing that you will observe is that this company is public or not. That's very easily observable, and that's a more recent statement. And so you first see the IPO event, and it's only later on that you might also have a look at, well, what happened before that IPO. Yeah. So it could be that the types of signals and how you get them work in a different order. So what you assume is that it's first one, the VC, and then second, the IPO. But what if it happens the other way around? And how does that then work with the probabilistic search story that you have in mind? The second issue related to this is primarily in the paper, not so much in the presentation. When I was reading the paper, what you argue is that receivers see the VC signal, yeah, and if it's a high reputation VC, it changes their expectations. I'm not sure who the receiver is at that point in time. It is the buyer that you're referring to, but in the paper that was not entirely clear to me. I was reading it. So this is the first step. So you attract funding from a reputable VC that sets an expectation. Second step is that at IPO, that expectation might not be met. And so that's harmful for, or that might influence specific types of investors you were talking about in your paper who then leave the company. That's at the stage of the IPO. So again, the receiver there seems to be someone else than the buyer. I hope that I'm clear in what I'm trying to convey here. So I think it's the buyer that looks at those two signals, which happen at different points in time. But the buyer views them at one point in time. And so it's a little bit more of clarification and explanation why that links to the probabilistic search. Third point relates to the gaps in that you've been relating to the gaps that are in the literature. It depends on where you will, what you target, but reviewers are generally very sensitive about theoretical contribution if it's entrepreneurship or management that you're focusing on. And I think you need to elaborate a bit on some of the contributions which you've highlighted also in your paper, but also in the presentation. So, for example, what you highlight is that previous works have applied signaling theory in an acquisition context, but they focus on public firms only. And obviously that's a shortcoming of those studies. But the fact that you remove the requirement of public firms, or not only focus on public firms, is not a theoretical contribution per se. It's you change contexts, but you need to clarify to the reader how that might also bring a contribution to the specific theories that you have in mind. The second one relates to the simultaneous occurrence of multiple signals. I agree that the studies that have looked at multiple signals, that they generally look at signals which happen at one point in time. But there are a couple of people who have not made the reflection which you did, which I think is very interesting. That is that sometimes we look at a bundle of or a portfolio of signals which have not happened at the same point in time. And we need to take that into account in our studies. You make that very explicit. There's other people who have the same type of data in different contexts, but have not made that very explicit. So to give you an example, there's Plummer and colleagues, which look at entrepreneurial ventures, which signal with product introductions and with affiliations. And they look at the interaction between those two as well. those signals did not happen, the product introduction and the affiliation, they do not have to happen at the same point in time. So they have the same type of data which you have, and they also look at interactions. Another study is by Osmel and colleagues, which also looks at interactions between different signals, venture capital and alliance formation. They don't look at acquisitions, but still within the broader signaling literature, they look at the VC and the alliance, which might not happen at the same point in time as well. What they argue is that there will be an interaction between VC and alliance because you don't need two positive signals, because that provides overlap. What you are doing is a little bit different in the sense that you indicate that there are stronger and weaker signals and that there might be incompatibility. That's something which those prior studies do not do. And I think that this is something which you need to stress more. So bring those studies in and stress more that what you have is in a sense, a richer set of signals that might be combined. Hypothesis 1 in the paper is a hypothesis which is a bit of a two-in-one hypothesis, in the sense that you first look at the effect of IPO or not, and then you look at the type of IPO markets, and those are combined into one hypothesis. I'm not sure that that is something that you want. For me personally, what I would prefer is that you start with a little bit of a discussion on what has happened in terms of VC signaling, what has happened in terms of IPO signaling, and then get by the 2x2 matrix, which you've shown in your presentation as well. And use that 2x2 matrix to start with your theorizing and building up the hypothesis. So go to hypothesis 2 quicker. And the different quadrants in your 2x2. So what happens if you have a prominent VC and a less prominent IPO, less prominent VC, prominent IPO, so those different combinations, and start to build theory on that a bit quicker. Selection and endogeneity. I know that that's generally a question which I don't like when reviewers ask them, but unfortunately that happens quite often as well. What you've done is you've worked on matching. You've used a matching technique, which in a sense is already good. Yeah, that's better than not taking selection or endogeneity issues into account. But you did the matching at a stage before you then get to the actual data set. Yeah. And so what I'm wondering is your final data set, is that data set still matched? So is the matching still valid at the end of your data construction? Because you start to do a matching, for example, between VC-backed and non-VC-backed companies, but then you collect acquisition data, you collect additional data, there's companies which disappear from your sample. So you've done a matching at an early stage, but I'm wondering, how is the matching looking later on in your selection process? By focusing on the matching and the instrumental variables which you use, which I think are all great, some people might also wonder, well, what about getting venture capital from a US investor versus a non-US investor? Is that a random process? Probably not. So there's probably some selection there as well. What about an IPO in the US versus an IPO somewhere else? Is that a random process? Probably not. So there's probably some more selection and endogeneity issues going on. Most of the time, it's very difficult to address these questions with respect to endogeneity. A paper which I personally like is the one which I am referring to here, because they get to instrumental variables, but then they also provide a somewhat different technique. I'm not going to go into the details, but they give an example there as well. So it's an application with real life data where they show different approaches, which I think might be helpful. And I've seen some of their alternative approach to instrumental variables also being implemented in some high quality journals, strategic management journal, for example. I've seen a couple of papers that use the approach that is highlighted by those people. So that might be interesting to have a more detailed look at. I also have a few small, more minor empirical questions that relates to some of the control variables, for example. Why not include year dummy or time effects? Because acquisition and valuation in acquisitions is somewhat cyclical. So there might be specific effects in terms of timing. I noticed that you use financial performance as a control variable, but it's the financial average performance between the IPO and the acquisition. Why specifically that measure and not performance just before the acquisition? So the most recent information that is available. There might be reasons why you're not doing it, but I'm not sure what they exactly are. What about firm leverage? Is that important to control for the leverage of the company, the debt financing which is used? One question, for example, which I had was, what is acquired? Is it the equity that is acquired, or is it the company that is acquired? Because if it's the equity that is acquired, or it's without or with the debt, which is that's the difference. Is it the firm, or is it the equity? Yeah. So it might be important to control for the debt position of companies. Next to financial performance, what might also be important is to look for the previous growth of companies. So how did the growth profile of those companies look like before the acquisition? Is this a company that was growing or not? Some questions which I also have, these are all questions which popped up as I read through your paper. When you talk about more reputable VCs, for example, you talk about US versus all the rest, and I'm wondering, could an alternative categorization be cross-border versus purely domestic VCs? Is that a possibility? Looking at it from a Belgian context, if you're a Belgian company and you raise Belgian VC, that's already great. But if you can raise it from US, that might be a stronger signal, as you say. But the same counts if it would be UK venture capital investor, for example. The other one relates to the more continuous measure of reputation, which you construct based on the number of IPOs and trade sales in which the investor has been involved. What you do there is you use a cutoff rate, which is the median. And I'm wondering if you score above median, is that really high reputation? Doesn't that just mean that you're average, in a sense? You're just above average, for example. You're just above the median. Is that really high reputation? So maybe you should think about using other cutoff rates as well. Discussion of the paper, I think if you target entrepreneurship or management, you probably want to extend a bit the discussion with practical implications and limitations and avenues for further research, at least in the paper which I've received. And then a final point of feedback, which is one which I also received in the past, was that sometimes a few interviews might be helpful because they might help you to bolster some of your arguments. So, for example, could you have a talk with a couple of companies that did an acquisition? How did they approach that process? What do they tell you in terms of the signals they look at? How does that, how does it work so that it can help you to get a bit of a more qualitative feeling of what's going on? Not that I want you to change this into a paper which is a case study paper. That's not my goal at all, but it's just to add some richness to some of the theorizing which you're doing, and to show people that within the context, these things are not just in the minds of the researchers, but actually that at least there's some cases where people think about those signals, how they interact, that people find that important during the decision-making process. So that's it. So what I would say is good luck, very interesting work. I think I've given you a lot of comments, but I think that the main point is that I would like to congratulate you, because I thought that it was very interesting work. So I really enjoyed reading it, and I think it's you're really onto something. So congratulations again.
Thank you, Tom. This was really an excellent, and I hope Benedetta will find very helpful these comments. I would like first give you the floor for a short answer and then open the discussion with the audience.
Yeah, thank you very much. It was really interesting, and you gave me a lot of comments. So I don't know how to tackle them all. I don't think I can tackle them all now, because there were a lot. But thank you very much. I really appreciated that. Thank you for the time you devoted to that. And I have also. I think that the main thing is about the probabilistic search, so the theoretical setting. And you say that these two signals happen in two different moments in time, but they are seen at the same time. So they are seen together in the same moment by the buyer. Actually, what we had in mind is that these potential buyers in our setting look at the companies in which they are willing to invest in along their life cycle and periodically update the valuation until it is time for them to buy the companies. So this is what we had in mind when we were thinking about the theoretical setting. And then we included also controls about like the timing between different signals to see if there was an effect connected to the time that we didn't see. But yeah, probably it's a strong assumption. So I think it's better that we, yeah, because the thing is, we find a significant and positive effect for the VC bracket signal, that is the older one, and also positive effect for doing the IPO in a more prominent stock exchange. And we know that these signals happen to be in sequence, so we really would like to take this dimension into account. But you're right in saying that from a theoretical point of view, the setting that we have to do in order to state this, so we have to make it more complex maybe, and we have to
maybe something which I forgot to mention, which I'm just thinking about now, is that in a sense, if it's really a sequence which goes on, what you could also do is you could look at what's the reaction of the stock market at that point in time, and then you get really closer, because you have the VC signal, and then when the stock markets, when you get quoted on the stock market, you have an immediate reaction from the stock market on the fact that you go to a lower quality or a more prominent or less prominent stock markets. That's maybe a different paper, but that's also something that I was thinking about, which I forgot to mention in the presentation.
So you're suggesting to looking at the effect of these signals in the moment in which they happened, basically.
No, I would just like to get more information about what you make as an assumption, and which I didn't understand when I was reading the paper, is that those acquirers are already tracking the company over time. Before VC, at the IPO stage, I think that that's a relatively strong assumption where I would need to have more information about. You might be able to convince me, but I would need to have more information about that. I think that in many times that does not necessarily happen. And then the question is, how does the probabilistic search at that point in time, how does that work? You also assume that companies have a long-term memory with respect to, if they're tracking companies, they're probably tracking multiple companies. So what you assume is this long-term type of memory. So what I'm saying is that there's just that's an assumption which I might buy, but I would need to have a bit more information about it. And the other one is that there's alternative ways to look at the reaction, which is to look immediately what happens at the stock market, which you do mention in your paper when you talk about probabilistic search. What you say is that if there's this prominent VC signal, and then at IPO there's a low quality, investors will leave. I remember I read that somewhere in the paper, because that's something which I highlighted. There you're talking about from my point of view and from reading, I would expect that are the people who might be interested in the IPO at that point in time. But that's a different argument. I'm not saying you want to go there. Probably you don't want to go there because that would be a different paper. But I'm just highlighting that people might ask you the question, well, why are you not looking at the IPO then? And why do you wait for many years later to see how those signals interact at the acquisition stage when they might already interact at the IPO stage?
Okay, so I would like to add something because it was interesting. I'm not in corporate finance, but this discussion for me shows something which is important, which is an avenue. In a way, my feeling, I come more from organizational theory, is that you are not using theory. So you are calling for bounded rationality, probabilistic search, but we are not using that theory. It's just appending there. And in a way, you are observing an empirical phenomenon and you are backward constructing a model, which is perfectly fine. Our research works. I would really encourage you to explicit your model and to make your model the contribution in a way seen from outside. The conclusions you came are not so theoretically relevant if you want. It's an interesting fact. What is relevant, they tell you something about the mechanism. It's exactly what Tom was saying. You are assuming behind that effect you are observing, there are strong assumptions on how the process works, valuation works. That's the core of what you are showing. So if you manage to convince that is real indeed this way of working, so that valuation takes place first in one stage when there is the venture capital backing, and then potential buyers remember or collectively remember this valuation and compare against this in a sequence of evaluations, that's a strong result. Exactly because authors might say the alternative hypothesis is that as a buyer, I come and I see all signals simultaneously. And then, of course, I'm not creating expectations. Expectations works only on time sequencing. So the core, you are assuming there is time sequences in this process. And if you can defend this, the paper will provide more contribution. And I'm really following Tom on two things. One, you need to elaborate much more the process, and one way to create credibility is to look into the literature on probabilistic search and whether you find that this works indeed in that way. And the second is, for this part, I agree with Tom, some more qualitative evidence that the process works that way would pave the way for your empirical results. So I think this points to a strength of the paper, but this needs to be really exploited so that when people come to the final results, it's not just these nice effects. And by the way, seen from outside, only the statistical effects are not extremely strong. And since the sample is not too big, you have many alternative measures, etc. But come to accept this as a further proof that the mechanism works as you hypothesized. So your conclusion will be the process and not the statistical effect. This would be my feedback.
Thank you very much. It was perfectly clear. And I agree with you. So probably I should elaborate more on the process and explain and prove that the process actually can work also in this way. And regarding the other comments, I definitely will add more control variables. So thank you very much for the suggestion that you gave me regarding control variables to put into the model. And yeah, I'm looking at my notes because it was so much, so I need to elaborate on these comments a bit. Yeah, about the problem of endogeneity, I agree, but the problem is that we have, so for dummies, so finding instruments for dummies is really difficult, so I will try to look for alternative approach. And thank you very much for writing the paper, suggest me that paper, so I will definitely go to check it and see what I can do with my different dummies. Thank you very much again.
Thank you. Maybe we should give first to the audience the opportunity to ask questions. Philip, you have to open your micro. Philip, open your micro.
That's it. I have one question. You started the presentation by saying we have multiple situations, and there is one important situation where there is no VC and no IPO, and then afterwards all that disappears, and we only discuss IPO and VC. So what is? I mean, you may focus only on IPO and VC. I don't discuss that. But then it's no need to speak about the amount of firms that are bought without before there is a VC or an IPO. So I mean, it's a consistency. It deals with the consistency of the paper. What you are not going to demonstrate. Why do you use it as an important situation in the beginning? That's a first comment. And I'd be interested to know whether, firms that buy startups, let's say, when I work on large firms who do buy regularly startups, I'm not sure that VCs and that they only buy firms when they have been backed by VCs. So that's an open question for me. And the second question is, I think there are as much variation in the quality of VCs within the US than outside. So I would really definitely prefer a solution that the one that Thomas said, which is about local VCs versus transborder VCs, or let's say VCs with a high sphere of activity compared to VCs which are really locally bounded. That would be my second comment. I really think US versus else is not a good choice.
Thank you.
Thank you. Thank you very much.
Maybe I would like to collect all of the questions so that are there other questions or comments from the audience? Apparently no. So I give you back the floor.
So thank you very much for your comments regarding the differentiation between VC US and VC else. I agree with you. We can definitely implement the cross-sectional versus domestic VC distinctions, so I will definitely do that. While regarding the first comment, I actually didn't get it. So when you said the first point that you made about so when you said that I didn't.
Let me explain it very simply. Your conclusion is about whether a low-grade IPO degrades a high VC, high-quality VC support, and then the value is lower. But what is the value? How do you analyze the value of those who have no signals? None of these two signals.
Okay.
Because either you only speak about these two types, these firms that are VC only or VC and IPO, and then you don't consider the other firms, so then your sample would be different than the one you described at the beginning.
Yeah, okay, I got it, yes. So you would suggest to discard the companies that didn't receive VC and didn't go through an IPO.
Or if you keep them, then you have to have conclusions. You need to include them in the conclusion.
Thank you very much. Thank you, it is clear now.
Thank you. Are there other comments or questions? So otherwise, I have a couple of things still to do. First, to thank Benedetta for an excellent and inspiring presentation. And I agree with Tom, you are really in midst of something. And what fascinated me is thus borrowing theories and approaches which in organizational behavior are well exploited and seems to be relatively new in corporate finance. So I think there is really a potential on that. I want to thank Tom because it's for me a model of how a discussant should act with precise, picky and challenging questions, but with the aim of helping the presenter to improve the paper. That's the life we are in. Then I have to thank the organization team, Serena and Alessio at CNR, for setting up this series. And finally, I ask Serena to put up the next the slides on the next seminar. The slide is coming. Okay, so you know we are moving around topics in RISIS, and the next one will be on hot topics. So basically on the impact of Brexit and other institutional barriers on the participation to UE framework programs. And this seminar will take place 10th of February, same time and same format, with the presenter Marco Cavallaro, which is a PhD student of me. And we have a very well-known discussant, Luke Georgiou from Manchester. I think that's really a core topic in the current European policy debate on research policies. So I really wish to see you again on that occasion. And thank you to everybody, and have a good afternoon.
Thank you.
Thank you. Thank you. Bye-bye.
Bye-bye.
Thank you. Bye.
Bye-bye.